Welcome back to the deep dive. It is Tuesday, February 24th, 2026. And I have to say, just looking at the pre-market action this morning and scanning the headlines, there is a very specific, a very palpable tension in the air.
Oh, absolutely. It feels heavy out there.
It really does. Heavy is the right word.
It's kind of like the silence before the cannon fire.
Yeah, exactly. Because we have been digging through a massive stack of technical analysis all morning, and the consensus from the research we're looking at is that we are staring down what might be the most high-stakes week of, well, the entire first quarter.
Without a doubt.
The sources are actually calling it a 5 days to decide scenario, which, sounds a bit dramatic at first.
It sounds like a movie trailer.
Right. But then you actually look at the charts they provided, and it seems completely justified.
It's not hyperbole at all. I mean, we are currently sitting in what the technical analysts call a resolution window. By Friday, the market is either going to break out and resume this bull run we've enjoyed, or it is going to break down structurally.
And the scary part, or the exciting part, depending on your positioning, is that the entire global market seems to hinge on a single earnings report coming out tomorrow.
It is incredibly rare to see it this concentrated.
Right, because usually you have, a dozen different macro factors pulling the market in different directions.
Yeah, you've got the Fed, you've got jobs data, international trade.
Exactly. But today, right now, we have equities, crypto, and precious metals all hitting these critical structural points at the exact same moment. It's like this binary verdict is coming down.
I like to think of it like a fork in the road. We aren't just deciding the trend for this week. The analysis strongly suggests we're locking in the trajectory for the next 3 months.
So the mission for our deep dive today is to really map out that fork in the road for you. We have a fascinating stack of documents. We've got a deep technical breakdown of something called the COVID echo.
Which is wild.
It is. I hadn't even heard of it before reading this, but apparently it's messing with stock algorithms right now.
Yeah.
We also have this path of zero resistance appearing for gold.
That's a beautiful chart.
And then, frankly, a pretty sobering reality check for anyone holding crypto right now.
Yeah, it is a volatile mix. You have macro headwinds colliding with very specific chart patterns. But if you take one thing away from this conversation, it needs to be the concept of the time frame hierarchy.
Time frame hierarchy.
Right, because according to the analysis, that is the only rule that really matters right now.
Okay, so let's unpack this. I want to start with the invisible ceiling.
The seasonal headwind.
Right. Because before we even get to NVIDIA or Bitcoin, the sources mention we are currently swimming upstream. They call this the most algorithmically hostile time of the year for equities.
Which is such a great phrase.
It is. But break that down for us, because why is late February 2026 so dangerous?
It sounds a bit like science fiction, doesn't it?
Yeah.
Algorithmically hostile.
Yeah, like the computers are out to get us.
But it's actually just math. It comes down to how volatility models are built by the big institutional desks, the banks, the big hedge funds. We're in a specific window right now, mid-February to mid-March, and the analysis calls this the seasonal headwind.
And this is where that COVID echo comes into play.
Precisely. You have to remember how these risk models actually work. They don't just look at today's news. They use look-back periods to price their risk.
Like historical data ranges.
Exactly. They look at 2-year, 5-year, and specifically 6-year rolling windows in this current model. Now think back to March 2020.
Oh, wow. Right. The crash, the whole pandemic drop, literally the world shutting down.
Right. It was a catastrophic, incredibly rapid drawdown. Volatility spiked to historic levels. And even though we're sitting here today in 2026, 6 years later, when the calendar hits this specific window, those historical volatility models reference that 2020 crash.
So they essentially remember the trauma.
They do. The algorithms remember the trauma.
Wait, let me play devil's advocate here for a second. Because humans know 2020 was a black swan event. It was caused by a once-in-a-century virus. Do the computers really not know that? Why would they penalize the market in 2026 for a pandemic in 2020?
That is the catch. Computers do not care about why.
They just see the numbers.
Exactly. They care about standard deviation. They see that historically, this exact calendar window has realized massive volatility. So the algorithms automatically adjust for higher potential risk.
Meaning they sell off?
They deleverage, they widen spreads, they pull back liquidity, and all of that creates a structural headwind.
So it's basically a self-fulfilling prophecy. The computer expects trouble, so it sells, which then creates the trouble.
In a way, yes.
Yeah.
It means that even if you have good news right now, rallies get faded. Big players sell into the strength. because their risk models are flashing orange. It's not necessarily that a crash is imminent, but the environment is just thick. It's really hard to move prices up.
The source used a great analogy that really clicked for me when I read it. It's like trying to run up an icy hill.
Oh, that's perfect.
Right, you might get a few steps of momentum, maybe print a nice green candle on the chart, but gravity is working double time against you, and you just slide right back down.
That is exactly what's happening. And the data backs it up completely.
Yeah.
Post-2022, this specific window has consistently marked a local top, followed by a drawdown.
Every single year.
Pretty much.
Yeah.
The analysis points out that the easy mode for being long equities, where you actually have liquidity and seasonality on your side, doesn't start until the second half of March, and then it runs through July.
Okay, so if you're listening to this and you're an investor trying to force a rally right now, you aren't just fighting the sellers, you're fighting the calendar.
You're fighting the math. Until mid-March, any stock rally you see should be viewed with extreme suspicion. The analysis implies it's likely a trap designed to grab your liquidity before the slide continues.
Okay, so that is a pretty gloomy backdrop, the icy hill. But even with all that ice, everyone in the market is looking at one hiker who might actually be able to sprint up it.
The main event.
We have to talk about NVIDIA. Earnings are tomorrow, February 25th.
This is the catalyst. It is the centerpiece of everything we're discussing. If the market is an engine, NVIDIA is the spark plug right now.
And what makes this so incredibly tense, according to the research, is that we have a clash of patterns. We literally have two different technical signals flashing red and green at the exact same time.
Yes. Let's break these down, because this is where that time frame hierarchy concept becomes so crucial.
Okay, on one hand, the sources identify a 3-week inside candle failure on the NASDAQ. Now, that sounds super technical, so what is it actually telling us?
Let's define it quickly for anyone not staring at charts all day. An inside candle happens when a week's price action stays entirely within the high and low range of the previous week.
Like it's trapped inside it.
Exactly. It represents consolidation, indecision. A failure means the market tried to hold that tight range and then broke downward out of it.
So the short-term vibe is basically that sellers are in control.
That's been the dominant vibe for the last few weeks. The 3-week chart clearly says go down.
Yeah.
And notice how that aligns perfectly with that seasonal headwind we just discussed.
Right. But then, and this is the huge conflict, you have this massive pattern forming on the higher time frame. The documents call it a double inside 2-month candle on NVIDIA and the NASDAQ.
Which is intense.
It sounds intense. But why does a 2-month candle matter more than the 3-week one?
Think of it as a coiled spring.
Okay.
Imagine price action getting tighter and tighter for 2 whole months. The range is compressing. Volatility is shrinking down to almost nothing. In physics, and definitely in markets, compression always leads to expansion.
It has to break out eventually.
Exactly.
Yeah.
Historically, when a structurally bullish asset like NVIDIA forms a double inside 2-month candle, it is not a sign of weakness. It's a sign of stored energy.
It's building up pressure for a massive move.
Massive pressure.
Yeah.
It usually precedes an explosive expansion to the upside. The market is just running out of room to coil.
Okay, so we have the 3-week chart screaming sell because of the algorithms and the COVID echo. And the 2-month chart is screaming get ready to launch because of all this stored energy. Who wins?
This is the time frame hierarchy. The golden rule in technical analysis, according to our sources, is that the higher time frame always outranks the lower time frame.
So the 2-month chart is the boss.
The 2-month chart is the boss, and the 3-week chart is just the employee.
I really like that. The boss versus the employee. So walk us through scenario A. What does the boss winning actually look like tomorrow?
Scenario A is the breakout. If NVIDIA reports earnings tomorrow and simply holds its range, I mean, it doesn't even have to skyrocket, it just has to not crash.
Yeah.
It confirms that 2-month pattern.
And if that happens?
It overrides the bear signal completely. The analysis notes that this exact same pattern happened in gold right before it went absolutely berserk.
Oh, wow. And that would validate what the sources are calling the AI productivity thesis, right?
Yeah.
It would essentially tell the market that all this massive tech spending is still justified.
It would. It would flip the bias for the entire tech sector from short to long almost instantly. It effectively melts the ice on that hill we talked about. The algorithm headwind just gets overpowered by the sheer force of the structural breakout.
But we have to look at scenario B, the breakdown.
Right. We have to be realistic. If NVIDIA sells off hard, like a classic sell the news event, and breaks below that 2-month low, then the boss gets fired.
The bullish pattern fails.
It fails completely. And because we were already in that hostile seasonal window with the algorithms looking to sell, there is no safety net. The slide could be extremely ugly.
So the stakes are literally that one single company decides the trend for the entire quarter in the next 48 hours.
It's a switch. It flips from short to long, or long to deep short in just 5 days.
Man. Now, speaking of things that are actually working out there, because if stocks are fighting this uphill battle against the algorithms, our sources are absolutely shouting about gold.
It's a golden ticket.
They call it the golden ticket. Gold is fascinating right now because it doesn't care about the COVID echo at all.
It doesn't care about stock market seasonality either. While equities are struggling, the source explicitly describes gold as the premier trade of the week.
They mention this very specific price zone between 5,100 and 5,426. They call it an air pocket. I love that term, but what does it actually mean practically for someone trading this?
That is such a crucial detail in the analysis. You have to look at the volume profile. When price dropped through that exact zone historically, during a prior correction, it moved so fast that it didn't leave any volume nodes behind.
Meaning what?
Meaning there is literally no historical price action. There is no memory of sellers in that specific range.
So there are no bag holders sitting there waiting to sell as soon as the price finally gets back up to their break-even point.
Exactly. That is usually what creates resistance in a chart, people desperate to just get out at break-even so they don't lose money. But here, it's a total vacuum.
Just empty space.
In technical analysis, price tends to move very quickly through these low-volume nodes. The chart is basically saying the path to 5426 is wide open. It represents a 6% rally just cutting right through empty space.
And there's this really cool detail about volatility that I honestly didn't know before reading this. Usually when volatility goes up, like the VIX, spiking stocks go down. Fear is bad for stocks. But the expert points out a quirk with the GVZ.
The gold volatility index.
Right.
Here's where it gets really interesting. When the GVZ spikes, gold prices actually tend to rise. It's the exact opposite of stocks. Gold feeds on volatility.
Why is that? Is it just because it's a traditional safe haven?
Precisely. Gold is a fear asset. If the GVZ is spiking, it means traders are nervous about something out there. It could be geopolitics, currency devaluation, tariffs, whatever. That fear drives them into gold.
And the source notes that the GVZ is currently signaling a spike.
Yes, which is a massive confirmation signal that this gold breakout is real.
So volatility is actually jet fuel for gold right now.
Correct. While equities are just trying to survive the week, gold is looking to sprint.
What about silver? Because usually if gold runs, silver runs harder, right? It's like the high beta version of the trade.
Usually, yes.
Yeah.
And silver is rallying. The source targets a move to 92 or even up to $106.
That's a huge move.
It is. That's a potential 17 to 29% gain.
But I noticed a big catch mentioned in the report. They seemed much less confident in silver's chart than gold's.
It is a very significant catch, and it goes right back to structure. Unlike gold, which held its structure beautifully and is pushing up into blue sky territory, silver actually broke a key structural level a few weeks ago.
The 3-week low.
Exactly. In technical terms, that damage really matters. It means there are trapped buyers sitting above the current price.
Okay. So unlike the gold air pocket where there's no resistance, silver actually has to chew through layers of resistance to get higher.
Spot on. Gold is making new highs. Silver is just bouncing back from taking a beating. So the analysis calls this silver rally a counter-trend bounce.
Got it.
It's tradable, and you could definitely be profitable doing it, but you have to know going in that it is not a blue sky breakout like gold. It is a recovery rally that will eventually hit a concrete ceiling.
That makes perfect sense. So gold is the clear leader, silver is the lagger. Now let's pivot to the section of the research that, it honestly feels like a bucket of ice water. Crypto.
Yeah. If gold is the path of least resistance, crypto is looking like the path of most resistance right now.
Let's start with Bitcoin. The source identifies a double inside weekly candle. Now wait a second. We just talked about that exact pattern being incredibly bullish for NVIDIA. Why are they framing it as a bearish thing here?
Context is everything in chart reading. Yep. Patterns do not exist in a vacuum. They exist within a broader trend.
Okay.
In NVIDIA's case, the pattern is forming right near all-time highs. In Bitcoin's case, this is happening after a significant downtrend. The source calls this arrested expansion.
Arrested expansion.
Yes. It signals that volatility is absolutely imminent, but the direction of that volatility is the major worry here.
They talk about a magnet price for Bitcoin at 93,673, but that's higher than where we are trading right now.
Right. There is a flat open on the 2-week chart at that exact level. Markets really hate leaving those inefficiencies open on a chart. So the baseline expectation is that we might see a bounce, a relief rally, pushing right up to that 93,673 level.
And here is the massive warning from the sources. The expert says, do not confuse a bounce with a recovery.
That is the line to underline, highlight, and circle, as long as Bitcoin is trading below 97,924.
Which they call the quarterly invalidation level.
Exactly. As long as it's below that, the trend is technically bearish. The source is very clear on this. Any rally up to that magnet level is a selling opportunity, not a buying opportunity. You are essentially supposed to be shorting the bounce.
And if we zoom out to the really big picture, the long-term target they gave is pretty scary. They mentioned 49,000 in Q2 of 2026. That is essentially a 50% haircut from the highs.
That's brutal.
Why so low? Where exactly is that number coming from?
It actually comes down to MicroStrategy. Ticker MSTR.
Really? Just one company?
Bitcoin has been trading in absolute lockstep with it. The analysts have spotted that MSTR's chart is targeting its own historical lows from July 2024. And the thesis is, if MSTR goes down there, Bitcoin goes right with it.
And if you overlay the charts, that July 2024 low for MSTR equates to Bitcoin hitting 49,000.
Yes, it's a purely structural correlation, but you have to respect it because for the last few years, it has been incredibly accurate.
So basically, enjoy the bounce if it happens this week, but be ready for the floor to drop out later this year.
That is exactly the read. And look, if you think Bitcoin looks tough right now, Ethereum looks even worse.
They literally called it the most sobering chart in the asset class.
It's hard to argue with that assessment. Ethereum has a double inside yearly candle failure.
Yearly? We're actually looking at a yearly candle time frame.
Yes. We are talking about a pattern that takes years to form, and it is resolving to the downside. It strongly suggests that the massive breakout we saw previously has completely failed.
And the target.
Deep. We are talking about liquidity pools way, way down at $874 to $1,067.
Wow. We are trading significantly higher than that right now. That implies a total collapse.
Which is exactly why the source says any rally to 2,400 or 2,500 is nothing but a dead cat bounce. It is a short setup. The structure is broken on the yearly time frame, and that is a very, very heavy weight to carry. It's like trying to swim to the surface with an anchor tied to your waist.
It really emphasizes how differently these asset classes are behaving right now. You can't just have a blanket risk-on or risk-off mentality anymore.
Absolutely not. The rising tide lifts all boats market is entirely gone for the moment. This is a stock picker's market and heavily a chart reader's market.
You really have to be specific. Gold is flying, crypto is dying, and stocks are just holding their breath waiting on NVIDIA.
That's the perfect summary.
Before we wrap up, there was one little nugget at the very end of the report that I thought was just a fun read, a bit of a teaser for this summer. The Space ETF, ticker UFO.
Oh, I love this one. It's a total pivot from all the heavy macro stuff we've been talking about. The chart is setting up for a really interesting play around $40.68.
And the catalyst for this isn't earnings or standard deviation models, right? It's rumors.
It's the SpaceX IPO rumors for summer 2026. The market is just starting to price in the excitement of that potential event.
It's a great reminder that even when the broad market is struggling with COVID echoes and algorithm traps, there are always pockets of innovation getting ready to launch.
Pun totally intended. So if you're watching the markets, keep an eye on UFO. But let's bring it back to the immediate 5 days to decide. We have a lot of moving parts here. Summarize the game plan for the listener who is just trying to navigate this crazy week.
Let's simplify it into 3 clear points. Number 1, NVIDIA is the key master. If it holds the line on February 25th, the 2-month bullish pattern overrides the bearishness. We rally. If it breaks, the algorithmically hostile window takes full control and we slide.
Got it. Number 2.
Number 2, gold has the cleanest lane. That gap up to 54.26 is a trade with 0 historical resistance. It is the easy trade in an otherwise very hard market.
And number 3.
Don't get fooled by crypto right now. Bitcoin and Ethereum are structurally damaged on the higher time frames. Rallies are likely traps to short into, not breakouts to chase.
It is going to be a wild week. I want to leave you with this thought from our expert notes today. We are living in a market dominated by algorithms that are looking backward at 2020, actively scared of a crash that happened 6 years ago. But we are also standing on the edge of this massive AI revolution, represented by that coiled 2-month candle on NVIDIA.
It raises the ultimate question for anyone managing money right now. Are you betting on the calendar, the seasonality, the mathematical fear, or are you betting on the innovation? The chart clearly says the 2-month candle outranks the calendar, but only if NVIDIA holds the line tomorrow.
Watch that 54.26 level on gold and keep your eyes glued to the ticker tomorrow. This is the resolution window. Thanks for listening to the deep dive.
Stay sharp out there.
We will see you on the other side of the earnings.